What if the biggest economic story of our generation isn't happening on financial television, but in cargo shipping manifests crossing the Pacific? While markets obsess over interest rate decisions, something extraordinary is unfolding in commodity markets that will define the next decade. China has figured out how to weaponize trade imbalances brilliantly. They're converting paper wealth into the actual atoms that modern civilization cannot function without. The scale is only becoming clear now in early 2026, as evidence becomes impossible to ignore. Chinese state-owned enterprises are engaged in the largest peacetime resource acquisition campaign in modern history. Systematic accumulation across every material category that matters. The metals making semiconductors possible. Rare earths powering electric motors. Lithium and cobalt every battery depends on. Copper forming the nervous system of electrical grids. China is locking down supply chains with methodical precision. Control upstream resources and you effectively control downstream manufacturing. Control manufacturing capacity and you dictate prices and availability. That's genuine economic power requiring no military force. It's leverage from controlling things people desperately need without substitutes. Numbers emerging in recent weeks are genuinely staggering. China's industrial metal imports have surged, even as domestic manufacturing shows cooling. This is stockpiling on a scale Western nations haven't contemplated since the Cold War. Chinese entities are accumulating physical copper at rates far exceeding current consumption. Metal disappears into state reserves that don't show in public statistics. The same pattern appears in nickel, cobalt, and lithium markets. Every kilogram of physical metal represents permanent conversion of financial assets into tangible industrial capacity. They accumulated massive dollar reserves over decades. Now they're systematically transforming paper claims into the actual building blocks of 21st century technology. It's among the most consequential wealth transfers in history, happening through millions of transactions that never make headlines. Recent developments have accelerated this strategy. Escalating trade tensions haven't slowed resource acquisition, but sped it up. If dollar reserves will lose value through inflation or depreciation, the rational move is converting them into hard assets immediately. That's exactly what we're witnessing. Less trade with Western nations means fewer dollars flowing into China through normal channels. Their response isn't reconciliation. They're diversifying trading partners, conducting more transactions in renminbi, and aggressively deploying dollar reserves into resource acquisition before those dollars lose purchasing power. Currency markets already reflect this shift. The dollar has faced significant headwinds throughout early 2026, continuing downward momentum from last year. When structural declines begin, they typically persist for years. Forces driving dollar weakness aren't temporary sentiment shifts, but foundational changes in how global trade operates. Precious metals markets in recent weeks show intense buying pressure from Asian markets, particularly China, despite volatility. Persistent premiums for physical metal over paper prices in domestic Chinese markets reveal demand for tangible assets continues outstripping supply. Chinese investors have figured out something Western markets prefer not discussing. In paper commodity markets, the ratio between contracts claiming ownership and actual deliverable metal creates fragility. The logical response is clear. Real exposure to strategic materials requires physical delivery, not paper promises. This dynamic plays out across industrial commodity markets. Growing recognition that strategic materials are becoming more valuable relative to fiat currencies drives purchasing behavior disrupting normal market dynamics. Premiums for physical delivery, unusual spread relationships, bidding wars for mining assets. All symptoms of the same underlying phenomenon. Chinese industrial policy documents make intentions remarkably clear. They view control of critical material supply chains as essential to national security. The difference is they're backing policy with massive capital deployment and systematic execution. Western nations are finally waking up, but responses remain slow. By the time programs launch, China will have secured dominant positions across dozens of critical supply chains. The window for competition narrows monthly. This is fundamental architecture of global power, shifting from financial abstraction to physical control of industrial inputs. Power increasingly derives from controlling tangible materials enabling advanced manufacturing. There's another major factor amplifying these dynamics. Japan. The Bank of Japan's recent monetary policy shifts represent seismic change in global capital flows. Despite raising rates, the yen continues struggling. The central bank has made defending the yen their paramount objective. Japan holds more than $1 trillion in U.S. Treasury securities. To fund yen defense and manage enormous government debt while raising rates, they need liquidity. The only realistic source is selling foreign assets. Even modest reduction in Treasury holdings creates enormous ripple effects through global markets. Then there's the yen carry trade unwinding. This trade, where investors borrowed cheap yen to buy higher-yielding dollar assets, only works when Japanese rates stay low. As rates rise, fundamental math deteriorates rapidly. The prudent move is exiting. This means selling pressure on U.S. assets, reduced dollar demand, and capital flowing out of American markets. Now see how pieces fit together. China systematically converts dollar reserves into physical resources while building alternative trading systems. The dollar faces structural headwinds from multiple directions. Japan prepares to potentially sell hundreds of billions in treasuries while carry trades unwind. Global trade patterns shift away from dollar-centric transactions. Strategic materials appreciate relative to paper currencies. These aren't separate trends. They're interconnected elements of fundamental transformation. Effects multiply, creating feedback loops where each factor amplifies others. Both superpowers compete for the same finite physical resources, both strategies putting sustained pressure on dollar purchasing power. Paper currencies steadily lose relative importance, while physical resources gain significance. The year 2026 is shaping up extraordinarily volatile for dollar-denominated assets. Multiple severe structural headwinds hit simultaneously. Most analysis dramatically underestimates how these factors multiply when converging. Wall Street analyzes each issue separately, but complex systems don't work that way. This is generational shift in global financial architecture. The framework dominating since Bretton Woods is being challenged through patient strategic economic positioning. China has played the long game, systematically accumulating physical foundations of industrial power while Western nations focused on financial engineering. Assumptions that worked for 50 years might not work for the next 50. Tangible resources and strategic materials are becoming more valuable relative to paper currencies. We're entering extended monetary instability, where traditional safe havens might not perform as expected. The rules are changing, driven by forces larger than any single central bank can control. Decisions being made right now will echo for decades. We're watching global economic power being fundamentally restructured in real time. And most people have absolutely no idea it's happening.